Talking about where we left off from our last episode, we talked about the rate hike a lot. So what was happening when our last episode dropped, as soon as that happened, there's a lot of misconceptions or a lot of worry around what was going to happen with that rate hike. And I think we were pretty bang on as to what we thought would happen. So we projected that a lot of people were going to get scared. It was more or less just a lot of talk. And not a whole lot was going to impact the market, but there was going to be a lot of fear in the market around people maybe just pausing and waiting and seeing what was going to happen. And that's really what we've seen in the last about month and a bit is it's kind of been like a lull. We haven't necessarily seen a dip, but there's definitely less demand. People are maybe kind of just holding off a bit and waiting to see what's going to happen with the rate hike. Nothing really happened. The prime rate has increased slightly, so it's now 2.7 for all major financial institutions. So if you're on variable term, odds are your interest payment is going up this month, or your mortgage payment is going to be going up this month. But all in all, it didn't necessarily affect the overall market in regards to buying power. What happens is we have to qualify a mortgage at either 5.25% or 2% above contract rate. And now everybody who's buying or getting a 5-year fixed term right now, they're just passing that 5.25% threshold now, or 3.25%. So you're going to start seeing with the next rate hike, or some right now, depending on the bank, the barrier to enter the market is going to shift. It's going to be a little bit more difficult for somebody to get into their first home. And I think we're starting to see quite a bit of people who are going to be moving out of conventional financing, maybe into something a little bit more flexible, maybe an alternative lender, or whatever that might look like, unless CMHC or some sort of conventional lender can come up with an option to allow for either increased amortization or more flexibility with their ratios.
Yeah, I think it's, one of the questions we always get is, do I go fixed or do I go variable? And I think, over the last couple of years, it was really kind of a matter of personal preference, what kind of flexibility you want from the mortgage. But other than that, in terms of qualifying, you were qualifying at that 5.25. But now that, fixed rates, I think on average from an A lender around 3.25, and, variable rates, these are insured variable rates, but insured rates are 1.6, 1.7. So as you start to see that fixed rate creep up, there is going to start to be the discussion, like Josh said, on a variable rate, you still may be qualifying at the 5.25, but as these variable rates are already at that 3.25, going fixed, fixed rates at 3.25, that's where you're going to start to see some of that higher qualification stress test rates coming in. And on the B side as well, too, B rates right now are sitting around 3.39 to 3.49. So if you're looking at getting a B mortgage and you're qualifying on stress tests, you're going to be qualifying 2 points above that contract rate. So I've already been qualifying some people at 5.49. But there are some products on the B side that can offset that. We have lenders in major city centers who will qualify at contract rate. So you're qualifying at 4.09 and not that 5.25 or 2% above. So there are some options there to kind of help offset that.
Yeah, back in the day, the B lenders never used to use that stress test. So is that a newer thing? Are they all doing it, or just some?
They're all doing it. They're all qualifying at 2% above contract rate now.
Yeah, that's a bit of a bummer. The thing I used to notice is they were pretty flexible about how you confirm the income, though. You could show other sources or other ways. They weren't as rigid with that. Is that still the case?
Yeah, that's still the case. You can have contributory income, or if people are living in a house, you can add certain income. You can also bump amortization out to 35 years, which reduces the carrying cost. So there is some really a ton of flexibility with these products, but their qualification is still unfortunately where it's at.
There's actually a lender right now who'll do 4.09 qualifying on a 1-year fixed and a 40-year amortization on the B side if you really wanted it. So,
I've done the math on that. Once you get past 35, it doesn't make as much of a difference when you bump that amortization out, but it still does make a difference. It's
how badly do you want to squeeze into that purchase? I guess. I mean,
hey, if it's a deal or no deal, you know what I mean? For me, I was always cash flow, whatever it was going to take. I still wanted it to pay off. I didn't want to just throw it on a HELOC. I wanted it paying down, but I always like to maximize the cash flow just for the what if. But if you got a good buffer, you don't need to. Just go reasonable.